Here with Jason Shapiro of JS Trading. You're here because you have a contrarian approach that is based on market participation and market action.
So, I mean, it really derives from the fact that I believe, there's a very large percentage of people that lose money when they're trading, probably in the neighborhood of 95%.
I was going to say, I thought it was 100%, but go on.
Probably 100%. So all I'm really trying to do is capture what they're losing. So I'm trying to find out what they're doing and be opposite them. And if they're losing it, then I'll capture it on the good side. That's the general idea of what I'm trying to do. I'm not trying to outthink the world. I'm not trying to think that I know where markets are going better than the rest of the world. I'm just trying to capture the fact that if everybody's losing, then I want to make. And so if I do the opposite of them, then I should make over time. So in order to kind of increase the odds, I'm looking at, participation data. And when people are super crowded on one side of a market, I'm looking to take the other side.
That's cool. That's very contrarian. So I guess where do you get this data and how do you know it's reliable?
So the main data source that I use is the commitments of traders data.
Okay.
Which comes from the CFTC every week. And that shows actual positioning, which I think is important because, you can look at survey data and you can hear people talk about they're bullish or bearish and all that. And that's one thing. But actual positioning, shows where their money actually is. Mm-hmm. And that's what I'm looking to fade.
So how extreme does the positioning need to be for it to interest you?
Very extreme. I'm picking major market turns. So at major market turns, I need positioning to show that speculators are extremely short if I'm going to be buying, and obviously extremely long if I'm going to be selling.
Okay.
So I take this data and I turn it into an oscillator, which goes from 0 to 100, and it needs to get above 95 for me to be a seller, and it needs to get below 5 for me to be a buyer.
What's the thinking behind this? Behind the fact that, is it just that that the crowd is wrong? Is it that simple? And that when things get...
To me, it's pretty much that simple. You can look at it a little bit deeper too. How does the market discount, right? A lot of people like to think that price is the big discounting mechanism and look at it as like, oh, well, this thing's gone down a lot, therefore it must be a buy. I don't look at it like that. I look at it like everybody is short this thing, therefore it must be a buy.
Right.
I look at that as the discounting method in the market, not price.
Really? Okay.
Yeah.